Welcome to The Explainer, where we break down the latest earnings calls. And today, we're diving into Deutsche Brse's Q2 2025 results. Now, this one's a bit of a head-scratcher. The company put up some really solid numbers, beat expectations, but the stock tanked. So what's going on here? Let's dig in. All right, let's get right into the central mystery here. On the surface, everything looked great. They beat on revenue, they beat on earnings, a classic beat and raise scenario, right? But the market absolutely hated it. So what exactly did investors see that made them hit the sell button so fast? And here you can see that disconnect in black and white. You've got GAAP earnings per share coming in at 277. That's a solid 2% beat. Pretty good. But then you look at the stock price, and boom, it drops almost 3% right after the announcement. It just doesn't add up, and that's the puzzle we're here to solve. So to figure this out, we've got to look past the big headline numbers. Peel back the onion a little bit. It turns out the market's anxiety was all pinned on one single thing, the Treasury result. Now, what's that? Well, it's basically just the income they make from interest on client cash. And with everyone expecting interest rates to come down, that income stream is going to shrink. But here's the kicker. Once you pull that one noisy number out of the equation, the whole story just flips. Okay, so let's do that. Let's just ignore that treasury income for a second and look at the real core business, the software, the trading services, the stuff they actually do. When you do that, net revenue grew by a really powerful 10% year over year. That's more than double the headline growth. It tells you the engine of this company is running super strong. But wait, it gets even better. Check this out. If we look at their profitability, the X-treasury EBITDA, that's a key profit metric, it surged by an incredible 19%. This is just a textbook example of something called operating leverage. It just means that for every dollar of new revenue they bring in, their profits grow even faster. Almost twice as fast. That is the sign of a really, really efficient business. So when you put it all side by side like this, you can really see the two different stories of this quarter. On one side, you have the headline numbers getting dragged down by a 25% drop in that pesky treasury income. But on the other side, you've got the core business absolutely firing on all cylinders with that sweet double-digit growth. And this, right here, is the critical detail that the market seems to have just completely missed. Now, this amazing performance in their core business, it's not some happy accident, nope. It's actually the result of a really deliberate long-term strategy. Management has been actively reshaping the whole company to make these strong growth engines the main event, and at the same time become way less dependent on the whims of unpredictable interest rates. At its core, the whole strategy is basically a three-step pivot. It's pretty simple, actually. Step 1, shift the business mix away from those areas that are super sensitive to interest rates. Step 2, deliberately bring down the company's overall exposure to those rate swings. And step 3, just let that awesome operating leverage we talked about in the core business do its thing and compound that growth over time. And hey, don't just take my word for it. This is straight from management's commentary. They're making it crystal clear. They are building a business that's based on durable, recurring revenues. Things like software, indices, the real nuts and bolts of market infrastructure. They're moving away from the roller coaster of interest rates. It's a fundamental shift in the company's entire DNA. And you want to see the proof? Look no further than their software solutions unit. Their annual recurring revenue, or ARR, grew by a massive 18% on a constant currency basis. And this isn't just organic growth. It's fueled by some huge new client wins, including the giant French insurer AXA and one of the biggest public pension funds in the entire US. That's a huge vote of confidence. So with all this powerful strength under the hood, management has the confidence to look ahead. And despite the market getting all jittery about that treasury income, they stood their ground. They came out and reaffirmed their full-year guidance, which is a really clear signal of just how confident they are in the core business. Yep, they held firm on all their key targets for 2025. We're talking about 5.2 billion euros in net revenue and 2.7 billion in EBITDA. And importantly, both of those numbers are ex-treasury. They're also keeping a tight grip on costs, with operating costs only expected to go up by about 3%. That's what you call disciplined. And when we look down the road, there are some pretty exciting catalysts on the horizon. They've got a new fixed income roadmap that's targeting an extra 300 million euros in revenue by 2026. Then there's the Made for Germany initiative, which could seriously boost the IPO pipeline. And they're even simplifying the business by returning some banking licenses, which should make them a lot more efficient. Okay, so let's put it all together. What does this all mean for you, the investor, as you're thinking about the next earnings call? Well, after digging through all the numbers and the strategy, we've got a take for you. We're giving this stock a rating of outperform. Why? Because we believe the market's knee-jerk negative reaction has created this massive disconnect between the stock price and the actual fundamental strength of the core business. So our core thesis is pretty simple. The market is totally fixated on this predictable, temporary headwind from interest rates, something management has already told everyone about and baked into their guidance. And in doing so, they're completely ignoring the much bigger story, this successful, accelerating pivot towards high-quality, recurring revenue. And this situation leads us to a pretty unique trade idea we're calling the barbell strategy. Here's the play. You go long on Deutsche Brse to capture all that upside from its awesome core business. But at the same time, you short a basket of European banks that are really sensitive to interest rates. What this does is it hedges out all that macro noise around rates that's unfairly dragging down Deutsche Brse stock. And of course, a quick reminder, this is all for informational purposes. It is absolutely not financial advice. Please make sure you do your own research. So the big question you have to ask yourself is this. Has the market gotten stuck looking in the rearview mirror, obsessing over a temporary problem, or is it missing the huge opportunity on the road ahead? Because from where we're sitting, there is a stronger, more resilient, and faster-growing business that's clearly emerging. And that, right there, is the multi-billion-dollar question.